All right, so good evening and welcome to the session today for our discussion towards the July 2025 examination. And this masterclass is going to be walking you through the entire syllabus, highlighting on the key issues that you need to understand to put you in the position to ultimately pass the examination in that particular case. And we're hoping that we'll be able to do a lot and then cover a lot of things to put us in that position to go into the exam hall tomorrow. I would say that we are going to be going through a lot of things this evening. And for some of you, maybe it may look like it is the first time you are going to be hearing some things or seeing some things. What I'm going to say is that shouldn't frighten you. I mean, the most important thing is whatever you have been learning so far, you should be able to go into the exam hall tomorrow morning for it in that case. But we're going to be getting into a lot of discussions as we go into the discussion today. Now, before I get into the discussion, if there are any questions you have for me, something specific that you would want me to comment on, then certainly I can comment on it in that case. So if there is any specific question that you have that you want me to share my thought on, those of you with me on the meeting, you can raise your hand, I'll bring you up, or you can put it in the chat for me. If there is anything specific that you want to pick my brain on before we get into the discussion. If not to, then I can start my discussion in that particular case. Give me a sec. Okay. I think I'm seeing a chat coming up on YouTube. Let me see if I can bring my chat up here. So this one said, James Naluku, please comment on the modification under IFRS 2. When you say modification under IFRS 2, what exactly do you mean? Because under IFRS 2, the generic thing is that any modification that is done to the scheme, whether due to the change in the number of employees or change in the vesting conditions on subsequent measurement, all we will do is we will remeasure the fair value of the share-based payment, the carrying amount of it, and then any movement will be going into the statement of financial performance or the statement of profit or loss for the year in that case. So if there is any modification for whatever reason, because the entity is making a policy, as I said, maybe the vesting condition, both the market or non-market based vesting conditions, there is a change. Or maybe there is a change in even the number of employees that the entity wants to make provision for. That is not going to be an issue. All we have to do is, okay, at the date or at the year ended or at the date that the modification is done, what is the carrying amount of the share-based payment that we have to work on? Once we get that carrying amount at the date of the modification or whatever change that has been implemented, then we compare that to the previous figure that we got, and the balancing figure is going to be going into the statement of profit or loss, and that could be either a debit, because modification can result into either an increase in the amount or a reduction in the amount. So whatever that is happening, we just account for it in the book. So there is nothing much on modification, aside if there is anything specific that you have, then maybe I can comment on that. But the key thing under modification is that at the date or year ended where there has to be a modification due to the vesting period or due to the vesting condition, all we do is recalculate the carrying amount at that date, compare it to the previous year's carrying amount or the carrying amount at the beginning of the year, and there may be an increase or decrease in the share-based payment, whether it's a share option or a share appreciation right, and that balancing figure is recognized in the profit or loss. So that is the idea about what you must understand when we talk about modification, if you want to look at it that way, under share-based payment. So let me know if that makes sense for you, and that is a comment coming in on YouTube in that case. All right, so I'm taking some questions first before I get excited into my discussion. So if there is anything specific that you have that you want to pick my brain on, you can put it in the chat, or those of you on the meeting with me, you can raise your hand and I'll bring you up in that particular case. So if there's anything specific you want to pick my brain on, you can put it in the chat, or those of you in the meeting with me, you can put it in there. Raise your hand and I'll bring you up. Then I'll see if I can answer those questions before we get into the discussion. Okay, so James on YouTube said, thank you, sir. All right, okay. So as I said, just look at the carrying amount at the date of the change and compare that with the opening figure, and that is all there is to be done on modification, if any. Okay. Yes, Godwin, your hand is up.
Sure. Please, kindly elaborate a little bit on modification of financial lease in the book of liaison, whereby the number of years has changed. Let's say initially the number of years in agreement is 10 years, but along the line they change it to 5 years. Subsequently, please, how do we treat that kind of transaction?
If I get a context of your question well, you are talking about modification. So the first time so what type of, because if you're in a lessor book, the lessor must classify the lease as to whether it's an operating lease or a finance lease. So what type of lease are we talking about here?
Finance lease.
Okay, so finance lease, the economic useful life of the asset has changed in that particular case. So what we would do is to remeasure the present value of the net investment in the lease. Okay, we remeasure the present value of the net investment in the lease. If you remember, we solved a question in class where in the lessor book, there was an adjustment. No, not even in the lessor, that was in the lessee's book. There was an adjustment based on the consumer price index. And so we use that as a basis to remeasure. So what happens is that because the initial measurement was calculated by discounting the future cash flows, on subsequent measurements, if the date changes from 10 years to 5 years, as you are mentioning, we'll just remeasure the net investment in the lease. When we remeasure, the difference between that will be adjusted for in the financial statement, so that from that day on, the remeasured amount will be that which we will put in the amortized cost schedule by calculating the finance income lease payable, and then splitting it between current asset and current liability. So that's what we do in respect of that. You remeasure the carrying amount of the net investment in the lease based on the remaining useful life. So let's say we have leased the asset and we are in the second year, and it was a 10-year lease that we had worked for. But then now the lease has been 5 years. It means as we are in the second year, we have 3 more years to go. So in that case, 2 things are going to happen. Now that they are going to lease the asset for just 5 years, does it still meet the criteria as a finance lease or a capital lease? Because remember, the criteria must be met. So if the criteria that we established at the beginning was because the person or the lessee leased the asset for the equivalent useful life of the asset, that was why we classified it as a finance lease. Now that we are in the second year and the lease has been changed from 10 years to 5 years, which may mean that could be below the remaining useful life of the asset. If it is below the remaining useful life of the asset and it doesn't meet the criteria again for a capital lease accounting or a finance lease accounting, then certainly that derecognition must be done so that the entity re-recognizes the asset and account for it in accordance with IAS 40, because in that case, that becomes an investment property there. So at that date, we have to determine, do we still meet the criteria for classifying the lease as a finance or a capital lease? If the answer is yes, then you just remeasure over the remaining useful life and continue account for it the way we account for lessor accounting. But if, based on the change of the lease term, we don't meet the criteria again for a capital lease or a finance lease, then it has to be derecognized so that the entity will now be accounting for the asset in accordance with IAS 40, because in that case, it is an operating lease and will be accounted for at fair value. And we have to then derecognize the net investment in the lease and reintroduce the asset at its carrying amount on that date. And from that date, it will be carried at fair value through P&L. So there are 2 things there. Either at that date, we still, although there has been a reduction in the lease term, we still meet the lease, or we no longer meet the lease for classification as a capital lease, so we have to reclassify it. So that is the idea generically about the modification. If the lease term has reduced, but it is still meeting the criteria for capital lease classification, no problem. Remeasure the carrying amount of the net investment in the lease at that date over the remaining time in the lease. Then you account for it from there. But if the change is now going to require that we no longer meet the capital lease or a finance lease agreement or requirement, then we have to reverse back into classifying or reclassifying the lease as an operating lease and apply IAS 40. So that is the idea in respect of that treatment. So it will depend on, do we still meet the criteria at that date? Then that will determine whether you should continue to do lessor accounting or apply IAS 40, investment property. So that is the
Thank
idea
you.
there. Okay.
Thank you.
What else do I have? What the heck? Say, how do we get retained earnings at acquisition when you are given net asset of X amount at the acquisition? What the heck? I don't know. I'm trying to understand the spirit of your statement. How do we get the retained earnings at acquisition when you are given net asset of, say, X amount at acquisition? A couple of things can be done there. Give me a sec. Let's see if I can bring up my writing pad. So, for instance, if I understand what you're saying, means that at the date of acquisition, let's say that the net asset has been given to us as, say, $200,000, right? And you're looking for the retained earnings at the date of acquisition. Okay, so what you are going to do is the normal swag. So what do I mean by the normal swag? we still work for our share capital, okay? If there is share premium in the subsidiaries books, you're going to bring that as well, okay? You are looking for retained earnings at the date of acquisition. So that is what we are looking for. I'm going to hold on that in a moment. Then there could be fair value adjustment in the notes. So whatever fair value adjustment there is, whether you're supposed to add it or subtract it, depending on the context of the question, you bring the fair value adjustment. Then it will also depend on the context of the question, because sometimes it could be mid-part year acquisition, or sometimes what is referred to as mid-year acquisition. So in that case, that means that there has to be some pre-acquisition profit for the year, okay? Pre-acquisition profit for the year. So the profit for the year, a portion of that was earned before we acquired them. So let's say the post-acquisition period is 9 months. So the profit for the year then will become 3/12 times the profit for the year, pre-acquisition. So that may be worked out in that particular case. So that you have your share capital, they have share premium, fair value adjustment based on the context of the question, you have read it. Then your net asset, as we started with above there, is 200,000. It means the balancing figure would then become retained earnings. That is the idea about it. So it's not a rocket science. It's not like we are doing anything new. You just still follow the pro forma based on the way we need to calculate the net asset at the date of acquisition. And then the balancing figure, after doing your fair value measurement and share capital, share premium, the balancing figure will definitely become the retained earnings for you at the date of acquisition in that case. That's the idea about that. Let me know if that makes sense for you and you understand the treatment of that. Again, so for those of you who are joining now, I'm taking some questions before I get excited into my discussion. So if there is anything specific, okay, specific that you want to pick my brain on as before we get goosebumps, you can put it in the chat for me and then I will. Or raise your hand, I bring you up, those of you with me on Teams, so we can go. I'll sit in. Yes, sir. Okay, that's good. That's good. Yes, Daniel, your hand is up. Yes, Daniel, your hand is up. Okay, I think I would have to go to something else because we really don't have time. Please give me a moment. A couple of comments are coming here. Al Hassan said, can you share light on preference shares during consolidation? Al Hassan, I don't get a context of your question. Maybe give me some context of the question. Because if the subsidiary has preference shares, it will be part of their workflow and will work for it and bring it in that particular case. Certainly, if it is part of their capital, we will also bring it at the date of acquisition and work for it to determine a goodwill at acquisition. Do you get the idea? Because they have preference shares in that case. Now, one thing you must understand is that there are two schools of thought. If I get a context of what the heck you are trying to say, there are two schools of thought for the adjustment in that case. If it is being treated as equity, it means your net assets at the date of acquisition, you're just going to build in that preference share that they have. Okay? And bring it in as part of the equity shares in that, as part of the net asset in that particular case, and then write it off to get your net asset at the date of acquisition if we want to. So unless otherwise there is something specific, you can bring it up in that case, but we just add it. I thought my screen was up. So you just bring it in here, and then it'll be part of your net asset at the date of acquisition in that particular case. So that's the idea there. So Al Hassan, that's what I would say. I don't know if that makes sense or you have a certain clarity for your question. I will be glad for that. Lastly, let me see this one. Please, can you comment on the indirect holding adjustment under consolidation? That's pretty simple, James. The idea about that is this. So if I get what you're saying about indirect holding, parent company goes to acquire subsidiary, subsidiary also goes to acquire subsidiary, if that is what you are talking about. So let's say that the parent bought 85% of the subsidiary, so non-controlling interest here will be 15%. Then let's say that the subsidiary goes to also invest or acquire the subsidiary, and that is going to be, say, 70%. And so what is the controlling interest in the subsidiary? Pretty simple. In that case, give me a sec. Let me take this to the next slide. Pretty simple in that case. So the controlling interest in the subsidiary. The idea here is that any investment the subsidiary makes, both the parent and the NCI have their share of ownership in that investment. That's the idea. So any investment the subsidiary makes, that is the company in the middle makes, both the parent and the NCI have their share of ownership in that investment at the end of the day. And so if we are looking for the controlling interest, we will take the parent ownership. In my example here, they own 85%. So that's going to be 85% on 70%. And that is going to give you whatever the heck. Let's say 85, 70. That's like 59.5-ish in that case. So maybe we can run it over to 60% in that regard. So that is how you calculate, and sometimes that is what is called the indirect interest in the subsidiary. So that the NCI, non-controlling interest in the subsidiary, is going to be 100 minus 60%, and that's going to be 40%. Now, financial reporting students, this is above your pay grade. This is a corporate reporting issue, complex group structure. So if you're a financial reporting student, don't be bothered and say, oh, Shirai didn't teach us this one. You know already that this is a complex group structure. So that is how you calculate the indirect interest in the subsidiary, if that is the context of the question that you were trying to ask in that particular case. Now, sometimes the parent will have some direct investment in the subsidiary. It will be the same idea. So if I have parent, I have sub, and I have sub, right? And then the parent goes to acquire maybe 15% in the subsidiary. They own maybe 65%. There is NCI here. Then the subsidiary also has acquired control of them, maybe 60%. And so what will be their combined interest in the subsidiary? So we will bring in direct interest in the subsidiary, which is the direct investment the parent has, 15%. Then we will bring in the indirect interest through the subsidiary, and that's going to be 65 on 60, right? So 65 by 60, and that's 39%. And so you add the two up, and that is going to give you an amount of 54%, so that and that will be the combined interest. Okay? So that the ownership is 100, so the balancing figure becomes non-controlling interest 46, if I'm right in that case. So that is how we work for this. But even let me show you the another flow here. Assuming I am still staying with this without the parents having interest in the subsidiary, our workflow will still be the same generically. So even if the parent has no investment, what do we do? Still, the controlling interest will be brought like we did earlier, 65 by 60, and that gave us 39%. Let me just confirm this. Yeah, 39%. So that the non-controlling interest rather becomes like 61%. Now you have to be careful here because somebody will say, oh, we own only 39%. We cannot consolidate. No. We will still consolidate the second firm, the subsidiary. Why? Because we control the company that controls them. The only thing is that our ownership in them is 39%. So that is the idea and what you need to understand in respect of that. So that is indirect holding and how we work this out. So although the interest that the parent has in the subsidiary is just 39%, we will still consolidate their results. Why? Because the subsidiary controls them and we own the subsidiary, so we can consolidate their financial statements, although our interest indirectly in them is just 39%. That is the idea about indirect holding in consolidated financial statements. Let me know if that makes sense for you in that case. I'm seeing a chart coming up here. Oh, say that. My mic is disabled. Your mic is not disabled. Should be able to have. Your mic is not disabled. So you should be able to unmute, or you can put it in the chat if you cannot unmute so that we can go on with the discussion. So any other questions for me? Or we are good? I can jump into the discussion. Probably go into what the heck I have for you tonight as we clean it up. Who the heck? Thomas said what? Good evening, boss. Yeah, good evening, Thomas. Okay, think no questions here. Please drop the file for me. Yeah. Okay. All right. Okay. One more comment, then probably I can go. Let me see if this is a question related. Joseph said, I learned a lot from your lessons, sir, and they have helped me. They have helped a lot. I've passed my exams through the help of your videos. Keep up the good work, sir. Greetings all the way from Namibia. That's great to hear. Congratulations and wishing you all the best as you continue with your life and become successful. So thanks for that. I think you've been following us for like some time now. I can get a notice here on your chat. Okay. So I think that means we're good. I can maybe start jumping into the arena of our discussion and see what the heck we can do. So I want to start from the 20 marks area evaluation of financial statement. That will be in the exam hall. And if you remember, we've made available the ratio analysis document for you, which is giving you guideline on all of the types of ratio questions that the examiner can bring us. And then if the examiner brings the question, the way we are supposed to answer the question, and most importantly, write out our analysis. And that is a 20 marks area coming up. In addition to the traditional financial statement preparation, we said there are some theories also here that you have to be mindful of when it comes to that evaluation of financial statement. And that is going to be the evaluation of financial statements. And that is going to be objectives, right? Or importance of ratio analysis, objectives of importance. Then the last one will be limitations of ratio analysis. Okay, limitations of ratio analysis. But if you remember, I told you something that in a certain question, the examiner can ask you to also write theory about limitations of a certain decision being made. So if you remember the question we solved during our revision session, the pastry co question, where a company was seeking to acquire one of two companies. And so if you remember in the B aspect of that question where we were supposed to analyze, the examiner required us to also talk about the limitations of making acquisition decisions using the information provided in the question. And so that is also another theory issue that will be based on the context of the question, where the examiner is going to be asking you, if the question is like that, a predator firm is seeking to acquire one of two companies, and we are consulting from the predator firm, right? And so what are the limitations? Should a predator firm use just the financial information or the information provided in the question to proceed with the acquisition decision? So that is also another theory style under evaluation of financial statement. In that case, it means our calculation may take around 7 or 8, so that our analysis could take around 9-ish. Then the remaining 3 or 4 marks will be taken by that kind of question where we are asked to talk about the limitation or something else, make a recommendation for the company. It will all depend on the context of the question. So when it comes to that 20 marks area, across board, FRCR, evaluation of financial statement, we want to be mindful about the importance or limitations of ratio analysis, the importance or objectives of ratio analysis, and then the limitations of ratio analysis. That's going to be crucial for you as you go into the exam hall. Now, let's remind ourselves quickly, corporate reporting students, there are 6 types of questions you're going to be seeing in the exam hall. One of them will be there tomorrow. 6. FR people, we can cut you around 4 or 5. One of them will be in the exam hall, and the rules governing each of them will be different. And so the usual one is going to definitely be you having a simple financial statement, a simple set of financial statement presented to us, and we are just supposed to calculate the ratio and analyze. That's the first style of question. No headache, no notes, nothing. The examiner is just kind to you, right? It's the kind of question when you get up and kneel down and say, examiner, I love you from the bottom of my heart, because it's very easy. But that is the first style of question. Simple set of financial statement, boom, you analyze and go away. The second type of question is where things begins to get excited to the examiner, and he said, hey, listen, I even don't want you to calculate, just analyze for me. So the examiner provides us with the indicators, and he wants you to analyze. But remember what I mentioned to you during our revision session, that we may be required to use both financial indicators. We may be required to use both financial indicators and then non-financial indicators. The financial indicators are the ones you know already: profitability ratios, liquidity and working capital ratio, gearing and investment ratio or investors ratio. Those are the financial indicators, the normal ones you know. The non-financial indicators include issues about sustainability, social, and governance. Okay, the ESG issues, which we'll get into in a moment in that case. So for instance, as you remember, we discussed during the revision session, the examiner can give you some additional data that are not financial information, but are non-financial information, like carbon emission, right? Carbon emission. Then the examiner, the question will be like, 20x5, the carbon emission was 60,000 kilograms. 20x6, which is the current year, the carbon emission now is 25,000 kilograms. Okay, energy source. When it comes to the energy source, renewable energy, renewable. I can't even spell renewable. Can you imagine that? Renewable is maybe last year was 2,000 kilograms. This year it is 10,000 kilograms. Non-renewable sources of energy. Last year it was 5,000 kilograms. This year, which is the current year, it is now 3,200. These are non-financial information. So what does this mean? It is talking about sustainability and issues. So carbon emission, if you look at it, the carbon emission has reduced. Please be careful about this in the exam hall. The year arrangement on the top, you have to be careful. Because you see what I just did here? I brought the X5 on the left, X6 on the right. So we are moving this way. Other times we could move the other way, which means X6 will be on the left, the X5 the previous year will be on the right. Please be careful to know it. Because if you miss it, it is Zokbo. Everything you've done is zero. So that is something you want to pay attention to. It's just a small detail that you can miss. So please be mindful of that. Now, if I come back to my illustration here, carbon emission has reduced significantly by over 50%. What does that tell us? It tells us that in the 20Xs, the entity has adopted a more environmentally friendly way of doing its business. And that is why they have reduced significantly carbon emission, which means the organization is becoming more aware of its operation, the impact of its operation into the environment, and has taken measures to reduce the negative impact of its operation on the environment. Then you come to their energy sources. Renewable energy has gone up by around 80%-ish situation from 2,000 kilograms to 10,000 kilograms. Non-renewable, on the other hand, has reduced. No wonder the carbon emission also reduced more than 50%. So it tells you that now the entity is using a lot of what? Non-renewable energy. Again, the organization becoming aware of the impact of its operation on the environment and putting in place measures to reduce the impact by adopting environmental friendly methods of production or delivery of its goods or running of its services in that case. So those are non-financial indicators that the examiner can talk to you about. As I mentioned to you during our revision, corporate reporting students, you don't have an excuse. It is waiting for you 99.9% of the time. It is waiting for you. So in the exam, you're going to be having the non-financial indicators, some things like this, and then some financial indicators you are supposed to work with. 99.9% is waiting for you. FR people, that one we can't tell because so far the examiner hasn't gone that route yet. But who knows? He could visit there this semester, and Nuntina, I am explaining it to you in that case. Then we could have, the gender balance situation. Okay, you remember we mentioned this, the gender balance agenda, and say, hey, listen, maybe last year male to female ratio was 5:1, but now in 20Xs, male to female ratio on high positions, not just male to female ratio like on all parts of the organization, but really on top level management issues, it's now maybe 5:3. What does that mean? It means that the entity has changed its way to provide a more gender neutral, gender balance, and giving women more opportunity on the top, which is part of the women empowerment agenda. So we clap for the company. It is doing well, giving opportunity to women in that case. So those are non-financial indicators that the examiner can bring. All you need to look at is understand what the heck the indicators are and how those indicators, whether they are increasing or decreasing, what it means for the company. Do you get the idea? That is the understanding there. Corporate reporting students, 99.9% of the time is waiting for you. FR people, I don't know. You are on your own. it may not be there, and it will just focus on the financial issues, which is where you master, right? But that is the idea about that second part. The data is given to you. You're not going to do any calculation. Guess what? Just write an analysis for me. And that is going to be packed with like 15 marks question, because you are just writing an analysis. And so 15 marks, boom, it hits you, then you go in that case. Third type of question that the examiner can bring us is the vertical or common size analysis. Now, vertical or common size analysis is the same as the traditional financial statement we prepared, only that in the income statement, total revenue is taken as the line item in that case. So if you remember, I think I showed you a question like that during our revision. Let's see if I can pull it up once more, just to remind your heart of that particular thing. Give me a sec. Let's see if I can find it here. Come on now. Is it that far? Give me a sec. If I can't get it here, then you just go and refer to what I gave you earlier. There we go. Okay, give me a sec. Let me pull it out from my drive here. Copy reporting. Okay, to be here, financial reporting. Yeah, let me pull it up from here. Evaluation of financial statement. Yeah, this type of question. Okay, this style of question. Give me a second, let me drop it here. Okay. So this is the common size statement. In the P&L, common size statement in the P&L means total revenue is taken as what? The base amount. So those of you in the public sector, for instance, you know we prepared common size statement because it's one of the methods for evaluation of financial statement in the public sector. And all you are doing here is that your indicators are already available because this is gross profit in percentages. So that is your gross profit margin, right? Then we have operating profit in percentages, profit from operation. That is your operating profit margin. Then you have profit after tax in percentages, and that is the net profit margin. And you're going to be doing the interpretation in respect of that. Remember that, again, in the book, we gave guideline on how you analyze the common size financial statement here, vertical analysis, the things you are supposed to look out for, and the guideline for the analysis. So make sure you go through that pretty well. That is the third type of question we could have. The fourth type of question is changes in business. And we saw this last semester in the financial reporting examination where the examiner brought in, I think, disposal. Is it disposal or acquisition? One of them was there, change in business last semester for financial reporting students. So if the entity disposes of an operation at the beginning of the year, what do we do? You remember we said that, again, all those principles are available here, right? They are in the book. So if they dispose of a segment during the year, what do? We eliminate the disposed segment information from the previous year's financial statement to enhance comparability of the financial statement. Okay, then we compute the ratios again for the previous year. So it means here you are going to be having three different ratios. The original ratio for the last year as reported, then the adjusted ratios for last year by removing the division that was sold, their information from the last year, then you will calculate the ratios as reported in the current year. And that is very important. And we gave guideline on how those things are supposed to be treated there. Then when there is acquisition at the beginning of the year, what does that mean? It means the current year financial statement is a consolidated financial statement, but the previous year financial statement may not be a consolidated financial statement. So how do we bring the two financial statements on the same page? By removing the contribution of the division that was acquired at the beginning of the year from the current year financial statement. So again, Here you have three different ratios. The ratios for the last year, the ratios for the current year as reported, and then the ratios for the current year after removing the contribution of the division that was acquired or the subsidiary that was acquired during the year. You remember we solved the question in class during our executive revision master class. I think Medina also, and we discussed how the adjustment is supposed to be done. So that is also the fourth styling of question that the examiner can bring to us. The fifth one is my favorite. Probably this semester the examiner can visit that one because it is the question that is going to bring the best out of students, and that is financial statement with additional footnotes. Yep. So here, the financial statements are given, then the footnotes are presented, and you are supposed to apply some accounting standards, conceptual framework issues to be able to adjust the financial statement before calculating the ratios, then you analyze. And you remember we solved a question like that as well during our executive vision masterclass, showing you how those adjustments are supposed to be made, because it is going to affect our statement of financial performance. It will affect the statement of financial position in the calculation of the capital employed. Again, that is a styling of question that the examiner can bring tomorrow as you go into the exam hall. Then the number 6 question is solely for the corporate reporting students, and that is consolidated cash flow analysis. Consolidated cash flow analysis. Last semester, the examiner brought consolidated financial statement, corporate reporting. That was the question 1 that the examiner brought last semester. But consolidated cash flow analysis is one of the styling of the questions. Remember, in this document also, we have the issue in respect of how we analyze the cash flow statement. That one is strictly for corporate reporting students, and we gave you guidelines on how you are supposed to analyze the consolidated cash flow. So when it comes to evaluation of financial statement, these are the 6 types of questions. One of them will be for, in the exam hall, financial reporting, corporate reporting. The goal is to understand what you are expected to do under each of them based on the context of the question, then how you do or write out your analysis. Because my goal is to tell you the options available to the examiner. Your assignment is to find a way to understand everything there. And if you remember, we gave you the generic principles for interpretation of the normal ratios. So if we have the financial ratios available, profitability, liquidity ratios, and then working capital ratios, investors ratios, the generic rule for interpretation, you follow what we discussed in class. Remember, I told you that if you are explaining the profitability ratios, you want to just start from the way the financial statement of the entity is prepared. So you want to start from rev, right? Then you come to the gross profit. Then you come to operating profit margin or net profit margin. Then you come to the Rosalinda, return on capital employed. So why do you want to follow that? Because asset turnover helps you to assess the efficiency and effectiveness of the entity in the utilization of assets to generate revenue. Asset turnover ratio, AT. Okay, the asset turnover ratio. Now remember, when the asset turnover ratio is increasing, it may not mean the entity is generating more revenue. Because when the denominator, which is the capital employed figure, reduces, the fraction goes up in value. So you have to be careful because the asset turnover may be going up. It does not mean the entity is efficiently utilizing its assets in generation of revenue, but it may just mean there is a change in the capital structure of the entity because they have repaid some loan notes, they have bought back some shares, or they have revalue assets and the assets have suffered an impairment or something like that in that particular case. So start from there, then you come to the gross profit margin. Gross profit margin, you have to refer to the revenue, AT, and then the controls that the entity has on its cost of sales. The element of cost of sales. That is gross profit margin. Then when you get to operating profit margin or net profit margin, you have to refer to the revenue generation, cost of sales impact, and operating expenses in the analysis write-up. Then you come to return on capital employed. In return on capital employed, you may have to refer to revenue generation, asset turnover, cost of sales generation, control on cost of sales, gross profit margin, control on operating expenses, operating profit margin, then changes in the capital employed. All of these guidelines, we went through them, we have used them to solve questions over and over again, and you should be able to follow the guideline. What the heck? Give me a sec. Okay, you should be able to follow the guideline to write out your analysis. So that is what you must understand about the way you present your analysis. Remember, there is a difference between operating profit margin and net profit margin. And we highlighted that to you and we applied it as well in class, that it must be noted that there is a difference between net profit margin. In the net profit margin, you are going to be using the profit after tax or profit for the year. But in operating profit margin calculation, you are going to be using the profit before interest and tax figure. So please be mindful of that as well when it comes to this 20 marks area that you are going to be seeing in the exam hall. These are the things you must understand about evaluation of financial statement. What is my take? My take is what I've told you. Number one, learn the principles underlining each of the types of questions under the ratio that the examiner can bring. Number two, familiarize yourself with the way the analysis is supposed to be written based on the type of question the examiner will bring. Because remember, if it is like the pastry code question, you saw the way the analysis went. If it is the same entity year on year, there is a way we write out the analysis. If we are comparing our entity with another entity, there is a tone that we have to follow for the analysis. So it means you can't be robotic, straight jacket, and just go. No, the context of the question will guide the tone of your analysis, the structure of your analysis, and the words to use generically. You remember this because if you are comparing the same entity year on year, you are at liberty to use all those words. Oh, it is increasing or it is decreasing. It is higher or lower. It is rising or falling. Whatever the heck there is again. You can use those things. However, if we are comparing two different companies, you cannot say something is increasing or decreasing. You cannot say something is rising or falling. Because two separate companies, nothing will be rising, nothing will be falling. It is either one is higher than the other or lower than the other. It is either one is greater than the other or less than the other. So you have to be mindful about the context of the questions, bearing in mind the guiding principles based on the structure of the question to be able to write out your analysis. If you can do that, and we've been able to go through all of these things, solving questions, guiding you on the way you write the analysis. Yes, certainly some of you have written analysis. Some of you have never written any analysis. And so as you are going into the exam hall tomorrow, I don't know, you are on your own, but we pray for you that you'll be able to write something that will qualify for what has to be written at the end of the day. So that is the idea about ratio analysis. The final thing I would say there is even the calculation issue. Because you remember that when we gave assignment and those things, some of you were even struggling with coming up with a calculation. Because if we are supposed to do calculation, especially if it is going to be question 5 type of question, or it is going to be the question 4 type of question, then if you miss the adjustment or you don't pick the right figure, you toast it. And once your calculation is wrong, forget the analysis. It is Zokbo. So even on the analysis part, the way you pick up figures, and Probably even the formulas, you have to be mindful of that. Remember, if the examiner says calculate inventory turnover, you know that that is going to be your cost of sales divided by the average inventory or closing inventory. And the answer is in times. And you expect this ratio to be higher because the higher the better, the greater the better. It tells us how quickly the entity is selling inventory. But alternatively, we can also assess inventory management by using the inventory turnover period. Okay? Inventory turnover period. Or inventory holding days. That one is going to be your inventory divided by cost of sales times 365. And that one, our answer will be in X days. The lower, the better. Right? Because it tells us how long the entity is holding inventory before it is sold in that particular case. And that is what you need to understand when it comes to these things. So even the calculation side of things, you have to be careful because your mess can begin from the calculation. And if you mess it up, I'm sorry, but forget yourself, you get 0 for the effort. So be careful as you go about this side of the question. Yeah, we know 20 marks is going to be there for us, but be careful based on the context of the question and the guiding principle in the analysis, ratio analysis document. Let that be your guide, and based on the context of the question, remember the principle and the way you are supposed to do the workings and the various adjustments that must be done in that case. So that is the idea about this 20 marks area, evaluation of financial statements. Any questions about evaluation of financial statements? Specifically, if you have a question on something that you want to pick my brain on, quickly I could entertain some questions in respect of this 20 marks area. Specifically, if there are any questions, can put it in the chat for me or raise your hand. I'll bring you up. Those of you with me on Teams, specifically under this 20 marks area, or if everything is okay too, then we can be in a comfortable lead and continue. Okay, so roll it up, boom, take it there in that particular case when it comes to the idea in respect of that. Evaluation of financial statement, that is what we need to know in that regard. My second part is to take you to 20 marks area coming in the exam hall, and that is the theories that the examiner is going to be throwing at you in the exam hall. The written questions, okay? And if you remember, on Friday, that was what we did, spending time to look at those theory areas. Give me a sec. Let's see if I can pull this up quickly. CR, final. What the heck? EPS, okay. Then it will rather be here. If I don't get it, then I just want to see if I can copy what I wrote earlier. There we go. Yeah, you can copy it. It's here. Fireside chat. There we go. So 20 marks area, theories will be there for us in the exam hall. What are they going to be covering? Some conceptual framework issues. Maybe the IFRS foundation, something about the IFRS foundation, stages involved in the preparation or setting of standards and those things. They are introductory issues you must understand. Ethics. It's there. We must understand that. Consolidated financial statement. Corporate reporting student, that's done deal. You know that already. We've told you. There's a 5-mark question on theory waiting for you in the exam hall, and that is going to be question 4B. The specialized transaction, the B part of that, is going to be a consolidated financial statement question. So for the financial reporting student, corporate reporting student, it's a done deal area. We know that is going to come, a theory on consolidation. FR people, we don't know. You are on your own. The examiner may or may not bring it. Some IT issues, IT development, okay? Sustainability, integrated reporting, pretty important there. Then IFRS theories. That one is applicable either side. There will be a 5-mark or a 3-mark question on an accounting standard. I don't know what the heck the examiner is going to be bringing, but you must know that there will be a theory question on one of the accounting standard. It can be anything, both financial reporting and corporate reporting, and then corporate governance as well, the governance issues. So all of these are theory areas. For corporate reporting students, these will be packed in question 5. And so when you go to question 5, everything there, 99.9 will be a written question that you'll be addressing. For corporate reporting students, the theory will be spread across question 3, question 4, and question 5 for that 20 marks theory for you to answer in the exam hall. So these are the theories that the examiner is going to be getting excited about that we need to understand. I'm going to take the time to highlight on some few ones of them in the discussion tonight. Definitely, it's a lot there, so I can't go through all of them. We are pressed on time in our discussion, so I'm going to go through some few of those theory areas that you may be seeing in the exam hall, and it is important. And we've discussed all of these, so we are just going ahead and then talking about them again. So when it comes to consolidated financial statement, the highlights of some of the things that we may see in the exam hall will be exemptions from the preparation of consolidated financial statements. If you remember, we said the fact that a company has control of another company does not mean that company can prepare consolidated financial statements. So for instance, if we look at this complex group structure that we started the journey with, the company in the middle, it's a parent to the second company. But can they prepare consolidated financial statement? No. So exemptions, from preparing consolidated financial statement. Number one, the entity is a wholly owned or partially owned subsidiary. So in our example here, this company in the middle, it's 65% owned by another company. So they cannot prepare consolidated financial statement. 2, its debt or equity instruments are not publicly traded. So it is not on the capital market, neither is it on the traditional stock market. You cannot prepare consolidated financial statement. 3, neither is the entity in the process of getting its shares listed or its debt instrument listed on the stock exchange. You cannot prepare consolidated financial statement. 4, its ultimate parent prepares consolidated financial statements in compliance with the IFRS, which we spoke about as well, because the subsidiaries data will be included in the parent information so that the parent can prepare a single financial statement. So your data is already included in another company's information. How will you say you are also going to prepare consolidated financial statements? So those are what we discuss, exemptions from preparing consolidated financial statements. Then we spoke about indicators of control. That is an area that probably corporate reporting student, there will be a question about that you may see in the exam, because it's really a tricky area, how we determine whether we can consolidate or it should be treated as an investment in associate. Pretty tricky area, so indicators of control. Traditionally, control will be gained when we get what? We acquire 50% of the voting right of the company. Normally, the question 1 that we're going to see, consolidated financial statements, that is what we are going to be looking out for. The fact that we have acquired more than 50% of the company, so we control them. However, there are other ways that can indicate that the company has control over the other. And the first one is power to govern the financial and operation policies, power to appoint or remove majority of the board members, and the casting of majority of the votes in a meeting in that particular case. So that is what we must understand in respect of the indicators of control. So for instance, for theory purposes, the examiner can pull up something for us and say, hey, listen, Kukua Limited acquired maybe 40% shares in Ohima Limited. Okay. The terms of the acquisition are as follows. One, Kukua Limited will appoint maybe 7 out of the 13 board of directors for the first 5 years, or something like that. So look at what is happening here. Kukua Limited acquires 40% of the shares in Ohima Limited. Okay. 40% is significant influence, if anything. So we are supposed to have apply what? Equity accounting in accordance with IAS 28, investment in associate. However, because Kukua Limited can appoint 7 out of the 13 directors, what does that mean? It means that what's going on? Give me a sec. Okay. It means that they are getting majority of appointments on the board. They have majority to make decision on the board. If there is a vote, they will always win. They have 7. The remaining people 6. So if there is a vote, they will win. Because of that, although the ownership looks like an investment in associate, 40%, the terms of the acquisition makes it to give them control. So Kukua Limited, yes, can consolidate the financial statement of Ohima Limited. That is the idea about control. That's the idea about control. Then we spoke about goodwill. This is very important because you are going to be calculating goodwill in question 1, whether I like it or not, right? 2 things can happen when you calculate the goodwill. We can have a positive goodwill, which is the usual environment, and a positive goodwill means we paid more than the net asset of the entity at the date of acquisition. So if there is a positive goodwill, less any impairment in goodwill, we'll be recognizing that on the face of the statement of financial position. However, in some cases, the value of the business will be less than the net asset of the business at acquisition. In other words, how much we paid them will be less than the net asset of the entity. That environment means we are getting a negative goodwill. And if you remember, if goodwill is negative, that is called gain on acquisition. In that case, that gain on acquisition must be recognized in the statement of profit or loss if we are preparing consolidated profit or loss. If you are preparing consolidated position, then that gain on acquisition will be added to the consolidated retained earnings. In that case, there will be no goodwill figure that will be shown on the face of the statement of financial position because goodwill is negative. And if goodwill is negative, that means it is a gain on acquisition. So those are the 2 things you must understand. You could calculate your goodwill and it is negative. If you have done everything right, don't say, why am I getting negative? If you have done everything right, that is gain on acquisition. So if you are doing consolidated P&L, it comes as a line item there. If you are doing consolidated position, it will be added to the group retained earnings or consolidated retained earnings. And when you go to the statement of financial position, thou shalt not bring goodwill. If you are doing consolidated cash financial statement for corporate reporting students, that means if you are testing for impairment in the goodwill, when you open your goodwill account, there will not be any goodwill at acquisition on the debit side as the normal thing will be if we are preparing consolidated cash flow statement. But 2 things. why will we get negative goodwill? And number two, what do we do if goodwill is negative? So these are theory areas that the examiner can access that we need to be mindful of. So reasons for the negative goodwill. We spoke about effective negotiation. So the predator firm negotiated hard and got the deal. That's better there. Two, the seller lacks knowledge of the value of their business. We don't care. Ignorance of the law is not an excuse. If you don't know the value of your business, we come in, we're going to take it, and we don't care. Then three, forced sale due to financial distress. I mean, the seller is just in a hurry to get rid of the things. That could be the idea. So these are some of the reasons why there will be negative goodwill. These are all theory issues the examiner can throw at us under consolidated financial statement that we need to be mindful of in that case. Then certainly, what actions do we take if goodwill is negative? And that is going to be reassessing the fair value of the net assets, reviewing the acquisition errors, because maybe you got a negative because you missed the retained earnings at the date of acquisition calculation, or maybe the fair value adjustment figure, you did it wrong. Maybe you are supposed to add and then you have subtracted, or you're supposed to subtract and then you have added. So we review the acquisition for error that had been occurred in that case. Those are some of the theoretical issues that we need to understand. So for corporate reporting students, done deal, something from here is going to be hitting you in the exam hall for 5 marks. Financial reporting student, you're on your own. It may or may not be there. Nonetheless, you have to know about it. Okay? And so generically, if we have control over the company, a subsidiary, then we do a full consolidation. If it is a significant influence, then equity accounting IAS 8. But remember, we could also have other forms of investment, and we'll apply IFRS 9. So if we just buy shares in a company and it doesn't give us significant influence, neither does it give us control, then it's a financial asset in accordance with IFRS 9, and we may carry it at fair value through P&L or at fair value through OCI and account for it in that case. So those are the theories we must understand in consolidated financial statement and the issues there. Second will be the concept of sustainability, crucial for us as we go into the exam hall there. If you remember, we spoke about the fact that sustainability involved disclosing how a company's operation impacts environmental, social, and economic factors without compromising future generations. That is what sustainability is about. And there are 3 pillars, as we spoke about: environmental issues, making sure that we are efficiently using the resources. Economic issues, making sure we are efficiently using the resources. Environmental issues, reducing pollution and conservative nature or conserving nature. Social issues, improving the community welfare. But we said, why is it important for the entity to prepare sustainability report or do sustainability reporting? A couple of reasons we gave. One, it attracts socially responsible investors. So we get access to money from some investors who are keenly or interested in companies who are responsible socially or environmentally. Two, it can lead to better financing terms. Remember, we spoke about this. We can get loans and finances, other forms of finances at lower cost. Three, it builds the brand or reputation, because everybody would then know that, oh, this company is socially and environmentally responsible. And then certainly it encourages customer loyalty and even attracts talented employees, because there are some employees who want to work for a company that is doing something that would not harm the environment. And you remember we said this part of the world, I mean, people are not careful, are not interested in those things. They just want some salary to buy kebab or buy pizza at the end of the period. What are the challenges? It is difficult to get data, so difficulty in accurate data. Two, lack of global reporting standardization, because there are a lot of reporting standards or framework, which is the next thing we're going to be looking at. And then the resource intensive preparation process. We need a lot. the human being, the data we need, the softwares, the programs, a lot to be able to finish this. So these are some of the challenges for sustainability reporting. But then we spoke about the guiding principles for the sustainability standards. And there are a number of frameworks that we need to know about. The first one is the Global Reporting Initiative, and that talks about stakeholder inclusivity, sustainability context, materiality, and completeness, guiding us on the principle on how we prepare the sustainability report. Then we also have the Task Force on Climate-Related Financial Disclosure, and this provides framework for us to report on governance, strategy, risk management, metrics and targets, and then certainly the International Sustainability Standard Board's guidelines, IFRS S1, IFRS S2. Remember, we went through all of these things. So these are the frameworks that we need to understand. And if you remember, whilst we were discussing this, I brought up the EcoBank's financial statement, and you saw that EcoBank referred to some of these as their benchmark that they are using to prepare their sustainability report. So I emphasize that these are not just something in the syllabus to cover space, but they are crucial things that you are going to be seeing in practice. Those are the sustainability reporting standards that we need to be mindful of. Then we came to the brother of sustainability reporting, and that is integrated reporting. And we said that it takes sustainability further by explaining how an entity creates value using the 6 capitals, right? And so financial capital, manufactured capital, intellectual capital, human capital, social and relationship, as well as the natural things. But what are the guiding principles in preparing an integrated report? Remember, we said as per the International Integrated Reporting Council's guideline, we are supposed to be looking at 5 things: strategic focus and future orientation, connectivity of information, stakeholder relationship, materiality, reliability and completeness, consistency, and comparability. Then, if an entity is transitioning into integrated reporting, what is the recommended roadmap? What are the guidelines that we follow? What are the steps? So in accordance with Value Reporting Foundation, we said the organization must get organized, form a team, a reporting team. Number 2, establish a plan and reporting boundaries, because there is a lot we can report on. So we need to establish a boundary. 3, we identify the information need, we assess our control, and then we publish it and we improve upon our control. So those are the key issues that we mentioned under sustainability reporting as well that you need to be mindful of in that case. So sustainability 1, integrated reporting 2. Then the third layer that we went to was IT. Okay, so you may see some IT-related questions in the exam hall. Don't be surprised, because information technology is in your syllabus. All right, but this is not the kind of questions in KG2. What are peripheral devices? What is a mouse? No, that's not the kind of question we are talking about here. We are talking about IT in the accounting field, right? So what are the benefits? We said there is high quality of real-time data, it streamlines reporting processes, and it enhances or enables automation of accounting tasks, so that there will be a time coming we don't even need accounts clerk and those people, because the job that accounts clerks are doing, AI can do it. We can set up the accounting system, and everything is done automated, so that we are able to get a financial statement. Then the accountant's job now will be to use the extracted data, the finished financial statement, and analyze it, and then help management to make informed decision at the end of the day. But then every good thing has a bitter taste. So there are some limitations that we spoke about. If you remember, cybersecurity threat, it will not go away, because some people are there and that is their job. They would want to hack some system, just sometimes for shaggy reasons. They just want to see if they can come through the system. That's all. And that is there when we are using IT. Number 2 is data privacy consents. Very crucial. You remember we spoke about this in much detail. Third, dependence on IT know-how. Many people are not, IT savvy. Some people cannot even read their email. Can you imagine that? Some people cannot even sign up their email in their phone. They have to let somebody do it for them. And if you ask, they say, born before computer. What the heck? Do you know when computer was invented? But technical know-how, okay? That's another problem. Then the cost of running the IT system. That is also something there. So when it comes to the IT issues, the benefits, we got to know about them, the risks associated. So the examiner can build a story for us that, a company is seeking to automate its operations, and as the newly appointed financial controller, advise management on some of the challenges they are likely to face, or the threats they are likely to face, or the risks associated with that, and recommendations. That's a 5-mark question, and you're talking about the risks. So you're going to be explaining these and how the company can address some of those things in that case. Privacy concerns or cybersecurity threat, that is why the entity will build a lot of firewalls in their system, and sometimes it could be 3-layer, 4-layer, or even 7-layer firewalls. So if you're a hacker, you break the first firewall, it won't come. Second, it won't come. Third, it won't come. So we build more firewalls to reduce cybersecurity threat. Then passwords are going to also be limited to the system in that particular case, and that is going to be also linked to the privacy issues, so that only some people will have access to data, to reduce the data being accessible to other people, because some people are careless. Okay, they can just be at dinner eating, then they are talking about company information. Or they can be at dinner eating, then they are spilling out things they are not supposed to be talking about. So all those things can be a risk in that digital environment, because if someone has access to the system, it could have a lot of impact. Then we came to big data and then cloud computing, spoke about some of the issues there that we need to understand in that case. So in putting all of these together in the theory area, consolidated theory on consolidation principles, the sustainability frameworks, issues, then the theories and principles behind integrated reporting, benefits, limitations of sustainability reporting, then application of big data and IT systems in corporate reporting. So these are the things we must understand about those areas that we have to know about. So it is important you know that, because the examiner is definitely going to be bringing that to you. The final theory that probably I want to talk about a little, not that much though, but just highlights to you, is the concept of corporate governance. Please make sure you understand this well, especially financial reporting students, because definitely there's a 5-mark question waiting for you on governance. Okay, 99.9% of the time, that is your done deal on the theory. The CR people, your done deal is consolidation theory. FR people, your done deal is the governance issue. So make sure you go over the governance principles. Most importantly, the governance principle as enshrined in the Companies Act of Ghana. Okay, what is the governor? I think last semester that was what came also from the Act. And then the Security and Exchange Commission's governance code. Those things in that case. And if you remember when we're doing this in class, I told you that the examiner can pick a session of each of those things and ask you a question about them for 5 marks. So you need to be mindful. Either the examiner says, we'll ask you, tell me about governance issues from the Companies Act, or tell me about the governance issues from the Security and Exchange Commission's Corporate Governance Code, or pick a session of something either in the Companies Act or in the Security and Exchange Commission's Code and ask you one of the chapters. So you want to make sure you refer to those things very well. Or the examiner will pull up a scenario. And then in that scenario, you are supposed to assess the governance structure of the entity, like the question that we solved in class. So if done deal theory, there's a high probability FR students, this is going to be hitting you. CR student, you are not prevented from getting questions on corporate governance. You remember we discussed this and we were all together to talk about it in that case. So these are the theories. The last thing is ethics. I'm not going to be talking about ethics. We've spoken about that over and over again. So we could have a 5-mark question too on ethics in the exam hall, integrity, objectivity, professional competence, and due care, and then the threats, all those things, the way we are supposed to write out our answers. Make sure you know all of those things because theories will come in the exam hall, 20 marks, and these are the areas that we need to know about. And as I've told you already, in the exam hall, what you want to do is read all the questions and take out all the written ones you can do as fast as possible. It's easier. So you can save some time before you get goosebumps into the questions that are going to be requiring you to work more. That is the idea about the second phase of our discussion, the theories. 20 marks waiting for us in the exam hall. All right. So let's take a quick breather, right? Let's take a quick breather and then we'll come back. I'll get into consolidation. Then we'll look at some of the standards and then we'll be off in the next few minutes. So we take a 5-minute breather and then we will be back. Okay. So welcome back, and let's continue with the discussion. Now, those of you watching us on YouTube, Facebook, as well as on LinkedIn, you can, if you are getting value, give us a thumbs up on the video and share the video as well. It helps us a lot, and the video will be able to be pushed by the platform to reach other students just like you. So together we can help as many people as possible. So give us a thumbs up on the video, share the video, and then let's reach as many students as possible together. Because you might not know, someone is also preparing, but they have not seen the video yet. So sharing it in your groups, WhatsApp groups, Facebook groups, everywhere the heck it is, just share with them. It will really be helpful. And that is also how we can grow the community and meet or get to help many students across the globe as we continue with the discussion. So let's come to the big fish. The big fish for you people, some people are under the spell of this big fish, is consolidated financial statement. Oh my God. That is question one. The examiner is going to be hitting us with consolidated financial statement. Now, as I have told you, this should be your last or last but one question. Now, that is my candid advice to you. This should be your last or last but one question. I don't care how much the heck you think you know about consolidation. This should be your last or last but one question if you want to pass the exam. So be careful about that. Because sometimes you are going to be getting goosebumps and say, oh, look at it. It has only 5 notes. Oh, it has only 5 notes. I can do it. By the time you finish reading the first note, you realize that you don't understand. So you're going to sit down and be thinking. Then you come to the second note. There are some skirmishes there. Then you start getting some fear coming in that case. So you want to be careful. This should be your last or last but one question. Again, just a recommendation. If you get to the exam and something come over here and you go there, I pray for you. Okay? I just pray for you. Now, when it comes to consolidated financial statement, what are the things we need to get goosebumps on? Certainly starting with the workings, okay? So the goal here is to do workings, not to jump and go and extract any financial statement. You are not going to be getting any reward for that. But we're going to be focusing on the workings, reading the question as we go. And so certainly we're going to be getting our group structure coming up in the workflow. The importance of the group structure, as you know already, is to tell us the percentage of ownership that we have in the company, as well as any NCI. Remember, if we own 100% of the company, then there will not be any non-controlling interest. But if we own less than 100% of the company, there will be a non-controlling interest. The second thing that a group structure will help us to do, which is most importantly, is the post-acquisition period. If you miss this calculation, you're going to cause a lot of harm if you are especially preparing the consolidated profit or loss. At least if you are preparing consolidated position, yeah, you could cause a lot of harm though, but it could be a smaller harm. But in the performance statement of profit or loss, if you miss this guy, post-acquisition period, my goodness. So you got to be careful, because in the P&L, if the post-acquisition period is less than a year, you know the subsidiaries figure will pick X over 9, which means the post-acquisition period, did I say S over 9? X over 12. Because in the post-acquisition period, we are going to be picking only the portion of their P&L results that relates to the post-acquisition period. But in the consolidation, that one we consolidate their assets and liabilities. We don't care about whether it is a 6 months acquisition, a 2 months acquisition. So you got to be mindful about that. Now, in the group structure, sometimes the examiner will not give us the percentage of ownership. Or the examiner will say the number of shares that have been acquired, okay, or that has been acquired by the company. So you have to calculate the percentage of ownership yourself. In that case, it is pretty simple. And it will look like percentage, the number of shares acquired, and you know this already, right? Number of shares acquired divided by the total or the share capital of the subsidiary. Okay, times 100. Please be careful about the nominal value of the shares in the subsidiary. Otherwise, you will screw up the number of shares in the subsidiary. So when you take the statement of financial position, you're going to see share capital. If it is 1 Ghana cedi and then the value there is 40,000, no problem. It means the number of shares is 40,000. But if we have share capital and then in brackets you see 0.75 and the figure there is 50,000, then you have to calculate the number of shares of the subsidiary, and the number of shares of the subsidiary would then be equal to the 50,000 divided by the nominal value per share, 0.75, and that will give you the answer. So you want to be mindful of the nominal value of the share capital. That is very important. That is very important. So that is the first workflow we're going to be getting goosebumps on. Group structure, telling us about ownership, getting our non-controlling interest, and most importantly, knowing the post-acquisition period as well. The second thing that the examiner is going to be awarding a Mark II, significant marks, is going to be calculation of goodwill. Okay, so you need to know how to work with goodwill. Now, remember what we mentioned in the simple group structure, which is the FR people. You are simple people. So in a simple group structure, you know what the heck we are supposed to do already. Fair value of consideration transferred will come. Fair value of non-controlling interest will come. Then you bring the net asset at acquisition as we illustrated at the beginning of the class. But be careful, because the fair value of consideration transferred, there are components to it, and based on what is there and the way it is adjusted for. It could be cash consideration, no problem, we record it. It could be share exchange. If it is share exchange, then it is the parent company that is issuing the shares. So in that case, we are going to be using the share price of the parent company to determine the value for the share exchange. Now, if it is share exchange and we are preparing statement of financial position and it hasn't been recorded yet by the parent entity, then in the statement of financial position that we are going to be preparing, when we pick the parent share capital, the share exchange must be accounted for. And it must be splitted between share capital and share premium. And so, for instance, if the share exchange value that we got, the proceeds from the share exchange, the fair value, it's say, whatever the heck, let's say $10,000, it must be splitted between the normal share capital and then share premium. That is, if it is not recorded yet. The normal share capital is, you're going to use the nominal value. Okay, that will be given in the statement of financial position. You use the nominal value. That is what will go to share capital. The amount that will be left is the profit from the issue of shares. So profit from issue of shares goes to share premium in that case. Now, if it happens that it is a loss on issue of shares, then you write it off against retained earnings. Okay, meaning that the shares are issued below their nominal value. If shares are issued below their nominal value, then certainly what is going to happen is that you are getting a loss on the issue. So that loss on the issue will be written off against retained earnings. So be careful of that. Profit from issue of shares go to share premium. Loss from issue of shares, meaning shares are issued below the nominal value, will be recognized in the retained earnings, written off against retained earnings. So that is share exchange story. We got to be mindful of it. Then we could have these two guys, and you must know how to account for them. Either there will be contingent consideration, right? Or deferred consideration. Okay? Now, in the realms of the spirit, we are going to be still applying IAS 37, provisions, contingent liabilities, contingent asset, because they are all future payments that the parent entity will make to the shareholders of the subsidiary. So we have to discount that into present terms. That is, if time of value of money is to be considered. In some questions, the examiner will tell us directly that we shouldn't consider time value of money. But if we are to consider time value of money, then it has to be discounted into present terms. But the accounting is where the issue is. Contingent consideration means that the parent entity will make additional payments to the shareholders of the subsidiary dependent on meeting certain things. So this is subjective. Okay, it is subject to the subsidiary meeting certain KPIs. And the deferred consideration, that one is done deal. There is nothing about it. So if we discount it into present terms, on subsequent measurement, unwinding, so that finance cost, if we are preparing consolidated P&L, it will be part of finance cost. If we are preparing consolidated position, that unwinding figure will be subtracted in group retained earnings and added to the present value, and that will go to the statement of financial position. If it is due for payment within the next 12 months, current liability. If it is due for payment in more than 12 months, non-current liability. So that is the idea about deferred consideration. We discount, unwinding, finance cost, carrying amount to the statement of financial position, just like how IAS 37, environmental cost, we deal with it. But in contingent consideration, we could have a reduction in the money that we are supposed to pay them because they've not met the condition. Any reduction in the contingent consideration is an income that will be recognized. So if we are preparing consolidated P&L, then the reduction in the contingent consideration will be added to other income. If we are preparing consolidated financial position, then the reduction will be added to group retained earnings, so that when we go to the statement of financial position, the revised amount is what will go under liability. That is the idea about contingent consideration, because reduction in liability is an income. But remember the question we discussed, I think on Saturday and Sunday, about the fact that contingent consideration can also be what? Issue of shares. So not that we are paying them money, but we are issuing additional shares to them, but it will be in the future. In that case, that will not affect the number of shares in issue like the share exchange will. It is a share exchange though, but it will be in the future. So it hasn't been issued yet, so it wouldn't affect the share capital if we are preparing the consolidated statement of financial position. So that is also the third thing we must understand in getting the fair value of consideration transferred. Cash, share exchange, contingent consideration, or deferred consideration, and the way they are accounted for. The fourth thing certainly will be the issue in respect of issue of loan notes. Sometimes the share issue can bring out dilution in ownership. So the parent entities may not be, the shareholders of the parent may not be satisfied with that. So instead, they will issue shares to the subsidiary shareholders. They will issue loan notes to the shareholders of the subsidiary. So when there is issue of loan note, it's financial liability. We will account for it in accordance with IFRS 9. It's a loan. So any interest that has to be charged, if it is not charged yet, will be charged and subtracted from the group retained earnings if we are preparing consolidated position, added to finance cost if we are preparing consolidated profit or loss. These are the things we must understand about the elements. What we've seen the examiner doing is he brings more than one of the four in a given question. So as you go tomorrow, I don't know what the heck the examiner is going to do. So you may see cash consideration and share exchange, or deferred consideration and share exchange, or issue of loan notes and cash consideration. The goal is knowing how to account for them. Remember, if you miss it, that goodwill key consideration there, you've lost it. So that's what we must understand in respect of fair value of consideration transferred. Then when it comes to the NCI also, you remember there are two ways non-controlling interest can be dealt with. Either it is at fair value or it's at the proportionate method. or proportionate value. At fair value means that either stated in the question directly, or we'll use the share price of the subsidiary multiplied by the number of shares that the non-controlling interest own in the subsidiary. At proportionate method simply means we will take the NCI's ownership, okay, the NCI ownership of the, how do we call it, of the subsidiary, multiplied by the net asset of the subsidiary. That is the proportionate method. Why is this important? Because if NCI is valued at fair value, then any impairment in goodwill will be borne by both the parent and the subsidiary. The parent and NCI, sorry. So impairment in goodwill will be shared between the parent and the non-controlling interest based on their percentage of ownership in the subsidiary. However, if it is at the proportionate method, any impairment in goodwill, what do? Will be solely charged to the parent entity. There will not be any sharing there. So that is another reason why we need to know the method of valuation of the non-controlling interest. There was a time the examiner brought a question where nothing was mentioned in the question in respect of how NCI was to be valued. No information was given, but there was NCI. In that environment, we go with the proportionate method because that is the way we can do it. Because whether I like it or not, we will know the percentage of ownership of the NCI. And whether I like it or not, we will get the net asset of the subsidiary. So if we don't have any information about how NCI is valued, and we have finished reading the question, then we go with the proportionate method. That will become the basis for the valuation of non-controlling interest. Remember, I said net asset here. It means if we want NCI at the date of acquisition, we will use their percentage of ownership multiplied by the net asset of the subsidiary at acquisition. If we want NCI at the reporting date, we will take their percentage of ownership of the net asset of the subsidiary at the reporting date. So that is why I made it generic like that, because it can apply to at acquisition or at reporting date when we are working. So that is the second issue we need to understand in our goodwill workflow. Fair value of consideration transfer, its component and treatment, and then the non-controlling interest, how it's to be valued, and then the way impairment in goodwill will be treated. Then we come to the favorite part of goodwill calculation, which is the net asset of the subsidiary, which we spoke about a little earlier. So we're going to bring the share capital of the subsidiary, the share premium of the subsidiary. Then if retained earnings, we may have to work for that. Remember, we've solved questions in respect of how retained earnings at acquisition should be calculated if it is not given. Like the question Henry asked at the beginning of the class, we have net assets at the date of acquisition. Okay, then as we mentioned earlier in the flow, in the slide here, then we'll bring the net asset, bring share capital, share premium, fair value adjustment, then the balancing figure becomes the retained earnings, taking into consideration also any pre-acquisition profit there. So if the retained earning is not given and we have the net asset, that is one way we can calculate the retained earnings at acquisition. But another way that we can calculate the retained earnings at acquisition, if you remember, is to bring the retained earnings at the end of the year. Again, this is in the subsidiaries info. So you bring the retained earnings at the end of the year. Then you either add or less the profit or loss for the year, okay, of the subsidiary. If it is profit, sorry, let me take that again. If they made a profit, it was added in arriving at the closing stock, so we will less it. If it is a loss, it was subtracted in arriving at the closing stock, so you add it back. So you got to be careful about the workflow there, because you are working from the balance brought down upwards. So if the P&L of the subsidiary, they made a profit, then it was added in arriving at the closing figure, so you subtract it. If they made a loss for the year, then it was subtracted in arriving at the closing figure, so you add it back. Then if it happens that they paid dividend, that is the subsidiary paid dividend during the year, dividend paid is subtracted from the retained earnings in arriving at the closing figure. And so when we are reversing, we are going to be adding it back. And that will then give us the retained earnings at the date of acquisition in that case. So that is what we need to understand about the workflow based on the context of the question, always. You remember we solved the question in class where this rule did not apply, and then Henry's question rule also did not apply, and we used a different concept based on the context of the question to arrive at the retained earnings at acquisition figure. So you have to be mindful because that is a key thing. If you don't get it, your goodwill may be beans. If you don't get it, your post-acquisition profit or loss, you are toasted. So it's a very key area that we need to be mindful of as we go into the exam hall in that case. But you see, this is where a lot of people may fall. That is the fair value adjustment concept. Yeah. For corporate reporting students, there may be a question where there's no fair value adjustment. So you could walk away free. There may be a question on consolidation and there's no fair value adjustment. Other issues. But financial reporting students, everybody must know this. That's what I'm trying to say. Fair value adjustment will depend on the context of the question. So here you are applying accounting standards. If your accounting standards is weak, you may get it wrong here. And the conceptual framework also you don't understand, you are likely to get it wrong here at the end of the day. So it will always be based on the context of the question that you need to understand. So for instance, if they say, oh, at the date of acquisition, the carrying value of the asset is above the fair value, and the figure they quote is, say, $10,000. What does that mean? It means that the entity has overstated their asset. If they have overstated their asset, the 10,000 in the net asset schedule would have to be subtracted at the date of acquisition for us, and also at the end at the reporting date. So carrying amount is above the fair value. So the entity has overstated the asset. If they have overstated the asset, it means they had charged more depreciation than they are supposed to charge. So we calculate the additional depreciation, or it will be given in the question, and that must be added. You get a workflow, right? So you subtract the figure, the whole figure here, additional depreciation will be added. Meaning when we go to cost of sales, it will be subtracted in that case. So you got to be careful about the language. Another story the examiner can tell you is that, oh, the fair value is above the carrying value. So it's about the positioning of these two, which will determine how or what is happening. So in the second story, 15,000. What does that mean? Here, the entity has understated its assets. So the 15,000, we add it to the net asset. Okay? Since they had understated their asset, they've charged less depreciation than they are supposed to charge. So any additional depreciation, we will subtract it at the reporting date. Okay? That additional depreciation thing comes at the reporting date for the OG people who do net assets at acquisition, net asset at the reporting date. Then when you go to cost of sales, it will be added there. So you got to be careful. Now, I'm saying above here, the reverse is true below. But the positioning of where fair value is, where carrying value is, will determine whether you're going to add or subtract. So if your English is not good, you are toasted. Because that is English, not accounting. So that is what we need to understand there in that particular case. So that's fair value adjustment. Then also note that Any liability amount that the parent entity, the subsidiary had not recognized, and now we have to recognize it at the date of acquisition. Note, liability reduces the net asset, so we subtract it, not add. Liability reduces because we are looking for net asset, so the liability is going to be deducted. So be mindful of that. So technically, all I want to say here is this, that the fair value adjustment thing, it is about accounting standards. It's about a conceptual framework. And whatever the heck you're going to see in the exam hall, you make sure you read the grammar well based on the positioning of the item. Then you should know what they have done, whether you are going to add, subtract. Then the additional depreciation thing or amortization thing, because it could be an intangible asset, what you are supposed to do with it. These are the things you must understand in respect of the fair value adjustment. It depends on the context of the question, but your accounting standards will chase you down here. You can have IAS 23 coming up, borrowing cost. You can have IAS 37, provisions, contingent liabilities, contingent assets, following you here. You can have IAS 38, intangible assets, software. You remember the question we solved in class. Intangible assets, software, coming in here in that case. So the standards. Then certainly your IAS 16, property, plant, and equipment coming up. So the accounting standards can chase you a little bit here on that fair value adjustment thing. Remember, if you get it wrong, your goodwill is toasted. If you get it wrong, your post-acquisition profit or loss is toasted, and you could be toasted a lot. You're already toasted. So be careful. Remember the accounting standards will be applying here. Okay, so please, in calculating the retained earnings at acquisition, do you factor the pre-acquisition period when deducting the profit? Yes, if there is mid-year acquisition that we are looking at, then we'll factor that in the discussion. If it is not a full year, then we'll factor the pre-acquisition profit in there and adjust for it. So yes, it could be taken into consideration if it is less than a year acquisition. That's the idea. So we could go normal like this, right? And get our retained earnings at acquisition, right? So you could go normal like this. Then let's assume the pre-acquisition period, the post-acquisition period is say 7 months. Then you can come and add back that pre-acquisition profit issue. If it is profit, then you come and add it back. Then it will give you the retained earnings. So then in that case, this figure here will be retained earnings at the beginning of the year. Okay? Retained earnings brought forward. So that if there was profit for the year, then you come and add back the pre-acquisition so that you can get retained earnings at acquisition. So that is the idea in respect of that. Okay? So that's our fair value measurement situation in calculating our goodwill. We've spoken about goodwill already. If it is positive, you know what the heck you're supposed to do. If it is negative, you know what the heck you're supposed to do. But that is goodwill calculation. Simple group structure. For corporate reporting students, you're not going to have simple group structure, so don't even dream about it. Corporate reporting students, we are going to have a complex group structure. So if it is a complex group structure, then the goal here is that the goodwill calculation in the subsidiary will be the same thing. But your goal must be goodwill calculation in the sub-subsidiary. In the sub-subsidiary. So if you remember, we said whatever investment the parent makes, whatever investment the subsidiary makes, both the parent and the subsidiary NCI have their share of ownership in that investment. So in a complex group structure environment, if we are calculating goodwill in the sub-subsidiary, we said we would take the money that the parent paid the sub-subsidiary. Let me take that again. When we are calculating goodwill in sub-subsidiary, we would take the money that the subsidiary paid the sub-subsidiary and take the parent's share of the subsidiary of that figure. So it means the parent's ownership in the subsidiary multiplied by the fair value of consideration transferred. That's the subsidiary paid the sub-subsidiary. So that is the key thing we must understand here. So our goodwill calculation, the only thing we must be mindful of in complex group structure is in the sub-subsidiary, you will take the parent ownership of the subsidiary multiplied by the money the subsidiary paid the sub-subsidiary. That is the fair value of consideration transferred. And that is what we need to understand there. Everything else follows the same idea, just like the simple group structure. So that's our goodwill workflow, keenly there for us to know about. Then, certainly the third thing will be NCI, non-controlling interest. We've already spoken about non-controlling interest, but if we are preparing statement of financial position, then the carrying amount of non-controlling interest must be calculated. You remember already, we'll bring the NCI at acquisition. Then their share of post-acquisition profit or loss will be adjusted for. Then we get a closing figure. If you didn't include the impairment loss in goodwill in the share of in the profit post-acquisition profit or loss calculation, then it will bring the goodwill here as well in that particular case. Those are the things we must understand it. However, in a complex group structure, corporate reporting student, NCI in the subsidiary is the same as what you know already, the way we calculate NCI. But it is the NCI in the subsidiary that will change. So NCI in the subsidiary, what will change there is that, you bring the NCI at acquisition, okay? Like you know already, you bring their share of post-acquisition, whatever the heck, profit or loss. But remember the statement we made earlier, that whatever investment the subsidiary makes, both the parent and the NCI have their share of ownership of that investment. So the money the subsidiary paid the sub-subsidiary, you took the parent's own when calculating goodwill in the sub-subsidiary. So the NCI's own of that money is no longer in the sub-subsidiary, but is no longer in the subsidiary, but in the sub-subsidiary. So what we do here is that we're going to strap the investment of NCI that is now in the sub-subsidiary. So we're going to less the NCI's ownership of the subsidiary multiplied by the fair value of consideration that the subsidiary paid the sub-subsidiary. That is going to be subtracted. This is the only thing you must understand corporate reporting in the complex group structure. NCI calculation in the sub-subsidiary is the same as you know in a simple group structure. But the NCI calculation in the subsidiary, we have to bring this special item because their investment is no longer now just in the subsidiary. Part of their investment has now been put into the sub-subsidiary. So the portion of their investment that is in the sub-subsidiary must be taken from their investment in the subsidiary. That is the concept there. That's the concept. And these are the things I want you to be mindful of distinctively. So goodwill calculation. Goodwill in the subsidiary is the same. Goodwill in the sub-subsidiary, you pick the parent's ownership of the subsidiary multiplied by the money the subsidiary paid the sub-subsidiary. NCI in the sub-subsidiary is the same. But NCI in the subsidiary, we must remove the NCI's investment, which is in the subsidiary, which is now put in the sub-subsidiary. That is the idea about a complex group structure that we need to be mindful of. Then certainly the last thing will be intragroup trading. Intragroup trading. And you know the deals already. If we are preparing consolidated profit or loss, then all and we are dealing with sale of goods. Okay, sale of goods. If we are dealing with sale of goods, what is going to be happening is that all post-acquisition sales, keyword post-acquisition sales, must be eliminated. So the total post-acquisition sales of goods must be subtracted from revenue, subtracted from cost of sales. That's the first level, if we are doing consolidated profit or loss. The second thing then is that if there are unsold inventory, okay, if we have unsold inventory, then certainly we have to calculate provision for unrealized profit. Note that unsold inventory can be in two forms. What is already in the inventory of the related party in question, or goods in transit. But the key word here is about a double entry when we calculate the PUP. If we are preparing the consolidated profit or loss, then you're going to debit cost of sales. We debit cost of sales, or debit the account of the person selling as well, which is profit for the year if the subsidiary is the one selling. Now, when we say you are debiting profit, it means subtract it. We debit retained earnings if the parent is the one selling, and we are preparing consolidated statement of financial position. Please be careful what you are supposed to do based on the context of the question. If we are preparing consolidated P&L and the parent is the one selling to the subsidiary, and the subsidiary has some of the inventories in stock, and we calculate our PUP, the only adjustment we will make to the PUP is in relation to adding it to the cost of sales. Because you are not doing position, so there will not be any corresponding entry. But if we are doing P&L and position, then you will add it to cost of sales and go and subtract it from the parent group retained earnings if it is the parent selling. If it is a subsidiary selling, then you subtract the PUP from the profit for the year of the subsidiary. If you are doing net asset schedule, then it will come at the year ended and you subtract that figure from there. That is the accounting there. Then the corresponding entry will be credit inventory. So that when you're preparing statement of financial position, you subtract it from the inventory figure on the face of the statement of financial position. So that is the treatment for sale of goods. In addition to that is the reconciliation of the current accounts to the, your friend is saying, of the current accounts between them. Because at the end of the day, no one is supposed to owe someone. So the trade receivables, let's say the parent sold to the subsidiary. Then in the books of the parent, they will be having trade receivables. In the books of the subsidiary, they will be having trade payable. No one is supposed to owe somebody. So any balance outstanding between them must be cancelled when we are preparing consolidated statement of financial position. And sometimes, as you remember, the balances may not be the same because of goods in transit or cash in transit. Whatever be the case, we balance it up so we can get the figures and adjust for that on the face of the statement of financial position. That is the idea about sale of goods and what adjustment we are supposed to do on intragroup trading. The last thing there will be transfer of assets or sale of assets. Okay, non-current assets. Again, nobody is supposed to sell to somebody. So from the group perspective, what are we going to do? So let me give an example. Let's say the subsidiary sells an asset to the parent entity. I will just do one side, the reverse is true. And let's say at the date of the sale, the carrying value of the asset was 10,000, but then they sold it to them at 15,000. What it means is that the subsidiary made a profit of 5,000. From group perspective, we are preparing the financial statement as though all the entities is just one. So not a lot, 2 or 3 entities. So in that case, this unrealized profit must be adjusted for in the books of the subsidiary because the subsidiary was the one selling the asset. So they've not made this profit yet. So if it was profit, meaning they sold the asset above the carrying amount, then what is going to be happening is that we are going to subtract this from their profit for the year. If they made a loss, we're going to add it back in that case because they had deducted it, so we add it back. So we reverse whatever profit they have recognized in their books. That's the first thing. So in the books of the seller, we reverse PUP. In the books of the buyer, we adjust for depreciation. We adjust for additional depreciation. In the books of the buyer, we adjust for, in the books of, the buyer, we adjust for additional depreciation. In my example here, it means the parent entity will recognize the asset at what? 15,000. So they will charge depreciation on 15,000. But from group perspective, depreciation should have been charged on the 10,000. So what does that mean? It means in the context of this question, the parent entity has charged more depreciation than they are supposed to charge. So we look at the difference in the depreciation, and that excess depreciation will be added to the group retained earnings in that case. So that is the idea there. So the journal entry for the PUP will be to debit the profit of the seller, okay? And then you credit PPE if it was a profit. Then the additional depreciation, they have charged more depreciation than they are supposed to have charged. So you're going to debit PPE, and then you credit the profit, meaning go and add it back to the profit. This is what we do on sale of assets. So in the books of the buyer, adjust for the unrealized profit or loss with PPE if we are doing position. In the books, let me take that again. In the books of the seller, adjust for PUP and PPE if we are preparing position. Then in the books of the buyer, we are going to be adjusting for what? Excess depreciation, because either they are charging more depreciation or less depreciation. And these are the things we must understand. So in a simple group structure environment, these are the things we must understand. Please note that there are some accounting standards that the examiner can throw at you in the exam hall under consolidation. Regular customers there will be IFRS 9, financial instrument, or let me expand that CRA and make it like this, IAS 32, convertible loan note, issue of convertible loan note. So it could be one of the notes. Corporate reporting student, in the consolidated financial statement, you could see IAS 19, employee benefits there. You could see IFRS 2, share-based payments there. In the consolidation, it doesn't change the treatment. Your rule is your rule. The law is the law is the law. So whether in a consolidated environment, whatever there is to go to P&L, it will go to consolidated P&L. Whatever there is to go to position, it will go to consolidated position. But be mindful, one of the footnotes may be a standard, and you're supposed to apply your accounting standard knowledge in there. These are the things that we need to understand about this question one area, consolidated financial statement. Now, lastly, on corporate reporting students, you remember we spoke about foreign subsidiaries. That the main thing there under foreign subsidiaries will be to know what rates you are supposed to use generically at the end of the day. And so we said that you need a rate at acquisition so that you can translate goodwill at acquisition. So then we need the average rate. The average rate will be used to translate any impairment loss, okay, and also used to translate the profit or loss figures of the subsidiary. Then the rate at the year end will be used to translate the statement of financial position of the subsidiary, the results of the statement of financial position of the subsidiary. Then certainly at the end, we are going to be dealing with any foreign exchange difference, and that will be recognized in the OCI, if you remember. Any foreign exchange difference recognized in the OCI, and we bring the foreign exchange at the beginning of the year, less the profit or loss issue, depending on what is happening, and get a closing figure. So please make sure you go into that, because we don't know, maybe as you go into the exam hall tomorrow, there may be foreign subsidiary, and you have to know the way to play with the rates, because really in foreign subsidiaries, it is the rates that will be the key thing. Everything else is the same idea. And remember keenly, IAS 21 is chief here when it comes to dealing with foreign subsidiary corporate reporting students. Goodwill calculation will be the same idea. You just have to know how to translate it. Profit or loss, you translate the subsidiaries figure using the average exchange rate. Position, you translate the subsidiaries figures using the closing rate, and you'll be able to calculate your foreign exchange gain or loss and also account for that. So these are the things generically that we must understand that we can talk about in respect of consolidated financial statement as well. That's all in that case. Now, certainly, as we mentioned, there could be issues about step acquisition and those things, right? Disposal. I believe that you have watched the video on knowing the principles about stage acquisition, disposal, how they are dealt with. When we dispose of, when we don't lose control, it is treated in the retained earnings and the NCI. But if we dispose of and we lose control, then we stop consolidation, and it is a profit or loss on the disposal, and that must be recognized in the financial statement. So those principles, make sure you know them, because if we have stage acquisition or disposal, you have to know how to handle that as well in the consolidation. All of these nuances are the reasons why I said your consolidated question should be your last or last but one question. And so the strategy is you go with your theories, okay? Best practice. You go with your theories, 20 marks, take them out. If you have read well the discussions we've done tonight, you can take 13 or 15 of those theories. That's easy peasy. You can take it. Take them out as quickly as possible. Then from there, you can come to evaluation of financial statements. You know the rules, the principles. Whatever structure of question that will be there, you know the rule to apply or the principles to apply based on the principal document that we have shared and the discussions that we have had. So you can come to your evaluation of financial statement. From there, we are going to be going then into the standards, the IFRS issues. For before console comes in. Now, the reason I said standard was because, yes, FR people, you will see single entity, which is cash flow or the normal P&L and position. And CR people, it is going to be specialized transactions. But you know the standards are going to be following you under specialized transactions, whether it's business valuation or corporate restructuring, financial reorganization. That is why I put the IFRSs. Then we will have a dedicated question on the accounting standards. So we'll have a dedicated question on accounting standards. Now, for the most part, the non-current asset accounting standards, you're going to be getting something on them. My time is gone because I don't want to delay you. You got to go rest and then, So I want to see if I can wrap up around here today. So the non-current asset standards, you will be applying them whether I like it or not. So this is where we're talking about IAS 16, okay? IAS 37, IAS 38, IAS 36, IFRS 5, non-current asset held for sale, IAS 40. So these are all non-current asset related standards. Whether I like it or not, you're going to be applying this some way, somehow, somewhere. FR people, it could be in the single entity issue, or it could be in the dedicated question area. Something about these guys waiting for you. CR people, you are not accepted, you are not exempted. Something about these guys, 3 of them or 4 of them, if the examiner get goosebumps, which I expect him to get this semester, then they are going to be in the exam hall and you are supposed to apply them in that case. Then certainly FR people, IAS 12, whether I like it or not, is waiting for you. In the single entity financial statement, there will be tax there. So whether I like it or not, you have to make sure you are aware of this before tomorrow morning, 9 a.m. CR people, you are not also exempted from this particular standard because it could be called on dealing with the issue in respect of IFRS 2, share-based payment, the deferred tax implication of that. So you want to understand that. Then we have the three disciples that you must know about, which is IFRS 16, leases, IFRS 15, revenue from contract with customers, and then IFRS 9, financial instrument, and its brother, IAS 32, financial. IFRS 9 is financial instrument measurement and recognition. IAS 32 is financial instrument presentation. That is where convertible loan notes comes in. Then we have IFRS 7 as well, which is financial instrument disclosures. So these three guys, pretty important. It's likely that you may have question from one of them in the exam hall or all of them because revenue is key, financial instrument is key, leases are also key there. So you remember I told you this from the beginning, right from session 1 when we're looking at the overview of the discussion. We spoke about this in that case. So these three standards be playing a crucial role that we need to be mindful of at the end of the day. Then level 3 exclusive CR people, you need to be solid on your IAS 19 compensation, employee benefits, IFRS 2, your share-based payment, and certainly IFRS 8, the operating segment. These are your level 3 exclusive, and you have to be mindful of them as you go into the exam or 2 p.m. tomorrow in that case. Now, in addition to these standards that I've listed here, it doesn't mean the other standards are not applicable. Time will not permit me to go into some of the standards because, my time is already gone. I don't have to have you a lot here. You have to rest so that tomorrow you go. So time will not permit me to go through some of the standards with you. So I'm going to be wrapping up around here today because I had them as part of my slide to talk about some of the standards in my presentation, but the time is already gone and I can't do any of them. So it means that you are going to be going with what you have done so far, and then, you should be good in that case. But remember, to pass the corporate reporting or financial reporting exam, 70% depends on the accounting standards. And so because you remember when we're referring to the theory areas that we could have a dedicated question on the standards, but it's a theory. Then evaluation of financial statements, standards could be there when we are adjusting the financial statement. Then we spoke about the issue in respect of consolidated financial statements, that the standards will follow you there. Then we will have dedicated financial corporate reporting students, 30 marks dedicated on the standards. Corporate FR people, 20 marks dedicated on the standard. So really the standard takes a center stage when it comes to the idea in respect of passing the examination. And you saw how we refer to them under console evaluation, and certainly the issue in respect of, how do we call it? The dedicated question. Then for corporate reporting students under specialized transaction, business valuation to be specific, you are going to be calling on the standards for the adjustment in that case. So these are the things that you must understand. Certainly the other, based on the examination analysis documents that we discussed and shared with you, those standards that we mentioned that you need to be mindful of, the IAS 33 and those things, you make sure that you review them before you go into the exam hall tomorrow. And these are the things that, time may permit me to share with you today. Osune, please share. Unfortunately, no, we can't share this document because it's part of a project for our summary video that my team is working on. So it's not a document that we can share now in that case because it's is the second stage of our summary videos. You know, we have the summary videos there. So the principles on the summary videos, that is what they are currently working on here. So I cannot share it because I've not been given the green light to be able to share this. So unfortunately, I will not be able to share this document with you at this time because it is not in a mode or a manner that can be shared now in that case. So that is it about that. I'm going to wrap up here today. Any other questions for me? Probably I could comment on that briefly and then we get a heck out of this place. Please, bath, okay? Open shower, pour on yourself and go and sleep. Go and sleep. You're not the one who brought book in the world. Go and sleep. Relax. Because remember, your brain needs some relaxation to be able to work effectively tomorrow. So relax, get some rest. Tomorrow morning you get up, eat one of your best breakfasts in the morning. Not the ones you people eat. Some of you eat banku and okra stew in the morning. Go and queue for some wache before you go to no. Or go and eat. Take some heavy cocoa and kose and bread. They cut the bread like that into two, and then they put the kose inside. Then cocoa gagba. Then they no, not that one, but some quality breakfast. Okay, very important for you. Then make sure you get to the exam hall on time, right? Make sure you dodge the traffic. Either you will leave home early and you are going to be using public transport, so you will get there early, or whatever be the case, maybe just maybe you drive yourself, get there on time, or if you don't drive, you don't have a car, maybe you use the ride-hailing services, relax in the back, and be just reviewing and going through some things. So rest. Get a quality breakfast in the morning, get to the exam hall on time, and the last thing is your emotions in the exam hall. When you start freaking out, you have 10 seconds to stop that freak out. So immediately you start panicking, count 1 to 10 to break it up. Because when you start panicking and it goes beyond 10 seconds and you're not able to kill it, that is the beginning of your failure of the exam. Because you cannot recollect anything if your brain is not working well. So please, whatever be the case, I've told you this in class. Remember what I mentioned to you. When you get there and you feel like you are panicking, just calm down. It's an exam. It's not a death threat. Just calm down, okay? Maybe if you want to say a prayer, 10 seconds, just say a prayer, but calm down. And then you have 10 seconds to kill that fear so that your brain can relax. That is what I need you to do because your brain must relax to be productive. Otherwise, you get to the exam hall, Nhyira, I learned. When I got to the exam hall, I can't remember anything. Hey, my house people. No, it's not your house people. Nobody knows you in your house. The devil doesn't have time for you. I'm not disrespecting you, but the devil doesn't have time for you like that. Okay? The devil doesn't have time for you. Throughout history, there are only 3 or 4 people that the devil touched. So the devil doesn't have time for you like that. It is your own mind. You are the one causing your own problem. So just calm down. Stay highlighted. Stay motivated. If the panic comes, count up to 10, kill it. That is a psychological, emotional exercise you have to do. So you don't freak out in the exam or and fail the exam. And everything you've learned will go to waste. If there is anything I will leave you with, in addition to whatever the heck you are learning, it's your mental, emotional, and spiritual state throughout this week. Guard it so that it is peaceful, because that is the only way your brain can bring out the things that you have learned, and that is the only way you can go into the exam hall and pass the examination. So guard your mind, your heart, your spirit, at least throughout this week. Tomorrow morning, somebody is going to do something to you, and you'll be angry. Debbie, let the person misbehave. Okay? Maybe when you finish the exam, you get time for the person. Let the person misbehave. When you finish the exam Friday, Saturday evening, you can do the person shake. But from tomorrow, allow people to misbehave and give yourself the best treatment, because a rested mind, a relaxed mind, is the mind that can be productive. If not, everything you've learned in the last 13 weeks will go waste if you're not able to guard your heart, guard your mind, and guard your spirit in these weeks. That's it about that. We pray that you go into the exam hall and have the grace to be able to do what you have to do. Speed and accuracy is key. That is what I've recommended. Take the theories out, come to the ratios based on the principal document we share with you on ratios. From there, go to the standards. Let console be last but one question, and you are focusing on the workings. That is the strategy, and that is how you can go into the exam hall and pass the examination. So we wish you all the best, and those of you who will be graduating, we'll see you and celebrate with you on the graduation date. Those of you who will be writing other papers too, we hope to see you next semester, because registration will be opening for the November 2025 examination next week, Monday, right after your paper. Registration has opened, and you can register to start learning for the November examination. So we day inside. We'll be here, and we wish you all the best. So that's it about that. Take care of yourself, and please sleep. Okay? Sleep. Although I'll be on standby, okay, sleep. Okay, I'll be on standby. So if there's anything you want to pick my brain on, you can ping me, and I will assist you. Okay? But sleep. 2 a.m. Some people were sending me things yesterday, 3 days today, 2 a.m., 1 a.m. I'm saying, hey, people, they do things. 2 a.m., 1 a.m. That's where people are doing things. But it was interesting because I was also available to assist people and solve questions. And it was interesting, like people solving questions. I was jumping on a call with some people around that time, right? Because, I mean, people are studying and they needed assistance, and I was there. So that's it about that. So please go and sleep. All the best, and we'll see you some other time. Also then, thank you. It's a pleasure. Register for the remaining papers. When will the video go off? I don't understand. Which video? Like this live stream you're talking about, or which video? The summary ones. I think whatever paper you are writing, when your paper starts, that's off. Immediately the exam starts, access ends. If you want continuous access, you can have access after the exam, request access. You'll be required to make some marginal fee payment, and you can continue to have access if you are interested. But all video access will cease immediately the exam for that question paper starts. And that's how the system is designed. So it's automatic. So 9 a.m. FR no fine, FR is gone. 2 p.m. CR no fine, CR is gone. But if you want continuous access, you can always reach out and you'll be able to get continuous access in that case. All right? So that's it. Go in peace, and we will see you some other time. Probably tomorrow, not probably, tomorrow we'll meet for the Tuesday papers. I think so. What do you think? Okay. Yes, so tomorrow we will meet for the Tuesday papers, which is MA and Advanced Audit and Assurance. So those of you who will be writing that paper will be meeting as well. And technically, we'll be using the same meeting details, but it will be sent to you again in that case. So, Moni nyame nko, nyame ya adoma, yebeshia, ewo enjoyment center. Bye-bye.